Silver was rather quiet also, but we seem to be closing the week, possibly if we can close today, over $30 back above the silver squeeze highs. And if we can close June above 30, would be in pretty good shape. It looks like silver's bounced off the 50-day moving average. Don't know if that will hold, but so far for the month of June, which has been a cool down pullback month, staying above 30 for the month would be what we want to see. I do firmly believe that once the yen goes, the entire global Keynesian system based on the US dollar will go with it.
In today's market recap, big silver rally of 2024 stalled. Why and for how long? The big silver rally stalled because speculators were unanimously long. The market does not reward consensus trades. The silver market will require less speculators before moving higher. Silver experienced a solid bull run in the period March to May 2024. Right before hitting silver's first bullish target of 34.70, the big silver rally 2024 stalled. Why? And for how long? Just to be clear, silver will hit $50 sooner or later. The question is when exactly. It's a matter of when, not if. Silver experienced an excessive number of speculators betting on the long side in the silver futures market. This, as said in our premium silver alerts since April, would prevent silver from moving much higher in the short to medium term. Speculators finally are giving up. Finally, they have been hit undoubtedly during those days with larger red candles. Remember, this is a futures market indicator. The leverage is insane when holding futures, so a 5% one-day decline has tremendous effects on a portfolio holding silver long futures. It's too early to get excited, but speculators leaving the arena is the prerequisite for silver to move higher. Lovely development, likely just the beginning. There will be a point in a few months where speculators will be hating silver, which is when we'll love it. Now we'll show you the best clips, but first, smash the subscribe button and turn on notifications. Enjoy the episode.
We have the yen breaking up, which means breaking down because the higher this number, the weaker the yen is. This shows 158.26, but this is from yesterday. We are at 159 now, the all-time high being up here where that candle is at about 160 something, 160 point something. We could break that at any time, which would spur more intervention by the Japanese central bank, the Bank of Japan. And speaking of intervention from the Bank of Japan, here's an article that makes a lot of sense. This is from Reuters, published today, June 21st, 2024. U.S. finds no currency manipulation in 2023. None. Nothing. Japan added to the monitoring list. Oh, they're being monitored. So they're going to monitor Japan for currency manipulation. Well, the entire monetary system is currency manipulation. Let's go to the even funnier paragraph halfway down the article. Japan's intervention, subtitle. The official said, the one, I guess, deciding who's manipulating and who's not manipulating, Japan's recent foreign exchange interventions to prop up the value of the yen were not a factor in deciding to add the country to the currency monitoring list. Well, you see, when they actually manipulate their currency, that's not a factor in adding them to the currency manipulation monitoring list. That makes a lot of sense. The country with the biggest exposure to the US bond market, to the treasury market, is Japan, and their currency is crashing. And what are they going to do when their currency crashes? They will have to sell treasuries in order to buy US dollars, in order to sell US dollars to buy yen to strengthen their currency, which they've done, but it hasn't really done much other than keep the yen strong for another few weeks. But the market is a lot stronger than the Bank of Japan. I wanted to give some perspective here as to the problem with the yen, that it is mostly bonds. And why is that? Well, this graph here from Bloomberg shows that the Bank of Japan holds over 50% of the outstanding bonds, Japanese government bonds. So meaning the yen is the bond market. And if Japanese interest rates go higher, then the yen weakens because the yen is the bond market. And now to compare to the Federal Reserve, we have in the title, I calculated, if you calculate the amount of treasuries on the Fed's balance sheet versus the outstanding debt of the United States, you get the Fed owns 12.8% of the outstanding treasury bonds, and the Bank of Japan owns 54. So that's like 4 times what the Fed owns of its own bond market, meaning the yen is much more sensitive to Japanese government bond interest rates than the Fed, and the dollar, is sensitive to dollar interest rates. Now, there is something going on with the dollar in a technical sense. These patterns are more of an art than a science, but I did notice this, that whenever the dollar gets into a consolidated triangle, a crisis usually happens when that triangle is resolved. So we have three examples of this, one nested within another one, and then the third one that is happening now. So we have, if we look first at this black one, this is a long triangle from the top of the US dollar index in 2001, it looks like, and the triangle was hit in 2017, and it resolved itself right before the COVID crisis. The lockdown crisis over here in 2020, and then we had a huge financial crisis over here. Within that large triangle, we had nested within it a smaller one from 2010, 2014. 2010 was the end of 2008 financial crisis when the dollar sprung higher and then hit a low when gold and silver hit another high here in 2011. This is around when silver hit $50, if you remember, and I'm sure you do. And then we had another triangle closing in at the end of 2014. And then all of a sudden, when this was finally resolved, we had an oil crisis. The price of oil fell to, I think, around $26 ultimately in 2016. And OPEC was in trouble. It was a whole thing that started in December 2014 when this triangle was resolved. Now we have a third triangle that is forming and almost at a resolution here. From 2021, the all-time low in interest rates and the peak of the COVID printing insanity, to here, which was the dollar high in 2022, and we are in a very steep triangle that appears to be on the verge of resolution over here at about 105.2, exactly where we are right now. I didn't check, but somewhere around there. This could manifest itself in many different ways, in a reverse repo crisis, in a repo crisis, in a repocalypse, something like that. It doesn't matter exactly what the nature of the crisis is going to be, but if this remains true to form, it might be, then we're pretty close to something big. This is just a close-up of that same triangle from 2021 to now. You can see here that we're sandwiched between about 103.5 and 105.17, and we're very close to this resolving one way or another. I personally think it will go up as we head into a final dollar crisis when liquidity looks for dollars, because we need to service debt and everyone is suffering from high interest rates right now. So we have one liquidity crunch still ahead of us, and it's not going to take long. And from then, we're going to start the final printing round, as I've been saying since I began the Endgame Investor. Now, if you want a little bit of fun, I'm not sure how valid this is, but I saw it and I just wanted to put it in just for kicks here. So we have massive zoom out for fruity circus chartist triangle enthusiasts. That would be a good band name. I thought it sounded pretty nice, so I just put that in there. We have a triangle, maybe, from the top of the dollar in 1985. I think it was like 165 or something like that. Maybe I'm off by 10. It was some crazy amount when the dollar was strengthening off the back of Volcker's hikes from 1980. It looks like we've tagged that triangle here in 2022 at that top, and if you want to count this as a triangle, it looks like this humongous thing is going to be resolved pretty soon, and that's going to be pretty big.
In today's news recap, silver price slumps amid hawkish Fed comments, high U.S. yields. Silver's price edged lower and posted minimal losses of 0.38%. Elevated U.S. Treasury bond yields amid Fed hawkish commentary undermined the gray metal. The gray metal is neutral to downward biased after hitting an 11-year high of 32.51. Since then, the pair retreated towards an area near the 50-day moving average at around $29, which is the first support level. Momentum turned bearish, with the relative strength index standing below the 50 midline. Therefore, the first support level for silver would be the 50 DMA. If the silver price dives below that level, the next support level will be the 100 DMA at $26.40, ahead of the May 2 low of $26. On the other hand, if silver buyers conquer $29, they must clear the $30 handle if they want to retest the year-to-date high of 32.51s. Now, we'll show you the best clips of the latest interview, but first smash the subscribe button, check our links in the description, and hit the like button if you find our recaps valuable. Enjoy the episode.
Now this, if you're asking me what I'm looking at these days to try to triangulate in time the next financial crisis, I'd have to say it's this chart. And to explain this, this is the proportion of bank reserves that are taken up by repos, by overnight repos. Overnight repos is the bank lending between banks that I mention a lot, and that is the key to the basement or the dungeons or the sewers of the monetary system. So the repocalypse happened in September 2019 when repos took up about 85% of the outstanding bank reserves available. Now, today's number that just came out yesterday, actually, is 2.021 trillion. That's the amount of overnight repos now per night, as of last night, divided by 3.366 trillion. That's the amount of bank reserves available. So the amount of repos taking up, the amount of reserves taken up by repos, is about 60%, up from 57% last week. That's a big jump. Once we get to 85%, we should be in crisis territory. It doesn't mean it has to go that high, but reserves are falling. Repo volume is rising. So we could be here within the next, 2-3 months, maybe a little longer, maybe shorter. But this is definitely where we're headed, and we're not going to reverse until the Fed prints again. I want to show you where that chart comes from. So on the top, we have secured overnight financing volume. That's the repo volume. How many dollars are switching hands between banks every night? The last repocalypse happened around here when it was 1.2 trillion a night. Why did it happen there? Because the amount of reserves available at that time at the same date here is 1.38 trillion. So 1.2 trillion over 1.38 trillion, that's about 87%. That's where it comes from. So here we are here. Now we have 2.021 trillion a night. You can see that the volume has been rising up steadily since around July 2022 on a pretty consistent slope. And reserves now are 3.366 trillion. The regional banking crisis happened around here with 3 trillion. We're at 3.366 trillion. I just wanted to go into a quick chart of Bitcoin versus gold. How is Bitcoin doing relative to gold? Well, a lot of the Bitcoiners believe that there's been a new high as of 2024. Not quite, not really. There's been a lower high in 2024 at about 34 ounces of gold per Bitcoin, but we're in a triangle consolidation here as well. And the actual high happened in October of 2021, and we haven't gotten close to that. I guess we got close to it here, but we're headed down with a series of lower highs now. I called the Bitcoin top over around here this year earlier, and a lot of people made fun of me. Maybe I'm wrong, could be wrong. We'll see if I'm right.
What do you think of today's show? Do you agree with Rafi Farber? Will the dollar die pretty soon? And will gold and silver rise to the moon and beyond? Post in the comments section your honest opinion. Tell us what you're doing with your stack and share your experience with the Stackers community. Now watch this video right here because you'll love it. I see you on the other side.